Hey everyone, welcome back to Corporate Decoder, the place where we slice through the corporate jargon to find the juicy details hidden in SEC filings. Get ready for a wild ride because today, S-filing is packed with some really interesting stuff, especially for a company that hasn't really done anything operational yet. So we are diving into the S-1, a filing from a company called Accession. Accession Corp to Frecken, this is essentially what is called a SPAC, a Special Purpose Acquisition Company. This means they are basically a shell company with money raised from investors, specifically to go out and find another company to buy and merge. We think of them as a big wallet looking for a business to own. It's like a blind date for investors. This filing is an amendment to their initial registration statement. It's dated the 3rd of October 2025, and it tells us they are planning to offer 15 million units at $10 each for a total of $150 million. This money is what they will use to find and buy that mystery business. Each unit they are selling comes with one Class A ordinary share and half of a warrant. This means if you buy a unit, you get a piece of the company and a sort of option to buy more company stock later at a set price of $11.50. Per S-Hare, the whole idea of a SPAC is to merge with a private company and take it public. This one is looking for a mid-market company that can grow big time after going public. The company is based in the Cayman Islands, which is pretty common for SPACs. Their sponsor, Iris Acquisition Holdings, the LLC, a Delaware limited liability company, is going to buy some extra units too. That is how these sponsors usually get involved and make money. They also bought founder shares for practically nothing, really cheap stock that will convert into regular stock later. Now, the founder shares are a big deal. They paid only about half a cent per S-Hare for 5.75 million of them, and these shares will convert into regular class of shares later. This is where a lot of the SPAC's S-value comes from for the founders and early investors, and it means there is a big risk of dilution for new investors. Let's look at the money side of things. They are selling 15 million unit. So at $10 each, that is $150 million plus up to 2.25 million extra units to cover over. Allotments from the underwriters, meaning another $22.5 million if everything goes great. So we are talking about potentially over $170 million being raised. Out of that $10 price tag, 60 cents per unit goes to the underwriters. As a discount, that is $9 million just for the selling commission. And there is a deferred underwriting commission of $4 per unit, $6 million in total, that the underwriters only get if the company actually finds and completes a business combination. This deferred commission acts like a sweetener to get the deal done. So after all the underwriting fees and initial expenses, the company expects to get about $141 million. The catch is that $150 million of the money raised from this offering and a bit from the private placement units will go straight into a trust account. This money is basically held aside and can only be used for the business combination or returned to shareholders if no deal happens. Remember those founder shares? They bought 5.75 million shares for only $25,000. That is a tiny fraction of a penny per S-Hare. If the deal goes through, these shares convert into regular stock and can be worth a lot of money, even if the new company does do that well. For the IPO investors, plus there is an anti-dilution clause. That means if they issue more shares later, the founder shares might convert at a better ratio for the founders. This is a major dilution risk for you if you invest in the IPO. The filing is very upfront about this risk. They say the nominal price paid for founder shares can lead to significant dilution for public shares, and that the sponsor is likely to make a substantial profit even if the business combination causes the stock price to drop. This is a classic SPAC concern. The insiders have a strong incentive to get a deal done so they can cash in even if it is not the best deal. 4. Public shareholders now, for the really risky part, the company has to find a business to buy within 24 months. That is 2 years. If they don't find a deal, they have to give all the money back from the trust account, meaning investors get their initial investment back minus any interest and taxes. And guess what? The founder shares, warrants, and private placement units will probably expire worthless. This is a ticking clock this time. Limit puts a lot of pressure on the management to find a deal quickly, even if it means rushing due diligence or making compromises. That is a key risk for any SPAC investor. They are looking for a mid-market company with meaningful revenue and potential for growth. They like companies that are profitable or close to it, that are technology enabled and have solid management teams. Sectors of interest include TMT, business services, consumer products, hospitality, fintech, and more. It is pretty broad, but they seem focused on companies that can really grow after going public. Let's look at dilution. This table is I. Opening if there are no redemptions, and the over. Allotment option is exercised. The dilution is around $7.10. Per se, this means for every $10 you invest, you might only get about $3 in tangible book value right away. But if you consider a maximum redemption scenario where lots of people cash out their shares, the dilution can skyrocket to 97.3%. This is a huge number. It means that for every $10 you put in your share, S tangible book value could drop to less than $1 if everyone else cashes out. As of the 16th of July 2025, their actual net tangible book value was a deficit of over $20,000. This shows how little they actually have before raising this money. The as adjusted numbers look much better after the offering. But remember, the dilution tables show how quickly that value can disappear for public investors. The company has a pretty experienced management team. Though Sumit Mehta, their CEO, has a background in investment banking and has worked with other SPACs, Lisha Palmer. The CFO also has strong finance experience, and Rohit Nanani, the chairman, has founded an asset management firm and has SPAC experience too. They seem to know the SPAC game, which can be good, but also means they re-motivated to get a deal done for their own benefit. The risk section is extensive, and you absolutely need to read it. They detail risks like not being able to find a target, spending too much money on acquisitions, and potential conflicts of interest between the sponsor management and public shareholders. They really hammer home the point that the sponsor will likely profit substantially even if public shareholders lose money. This is something every investor needs to understand. The fact that they are a Cayman Islands company also means different legal rules apply, which can make it harder for US investors to protect their rights compared to a EU. This company, in the end, this filing shows a standard SPAC structure. They have a clear plan to raise money, find a target, and go public. But like all SPACs, the success hinges on finding a great company at the right price and executing a deal within their tight deadline. The dilution risks are very real, and the sponsors' incentives are heavily aligned towards closing a deal, which is a critical point to remember for potential investors. So do your homework, understand these numbers and risks before you even think about investing.